now I'm recording, and somebody has caught up to me, so I'm going to jump on the next end phase, right, of the course here. And here's where I left off, and I'm going to build this as our 21st session. And here we're dealing with the Miller-Modigliani theorem. Now this is coupled with the previous page a little bit, so look at the previous page, the hypothetical scenario without taxes. Managers, right, are acting on behalf of stockholders completely. No firm will ever go bankrupt. Equity investors are honest with their lenders. Firms actually have certainty about their financing needs. So how should the firm act in such a scenario? And this is what's the foundation of the Miller-Modigliani theorem. With this assumption, what's going on here is that the cost of capital is unchanged as the debt ratio changes. Secondly, the value of the firm is not going to be a function of leverage. And then third, the investment decisions are actually going to be independently made of the financing decisions, right? So you have these separated functions in a sense. And if you allow for tax benefits and you keep the other assumptions in place, the optimal debt ratio actually rises to 100%. Okay, and that's a simplistic world, of course, and that's very controversial. But Miller-Modigliani win Nobel Prize for the basic ideas they presented here, right? So a couple of comments here about this slide as you're reading it. Firms, they have fairly strong preferences in terms of where they want to raise capital. It turns out, if you look at evidence, firms tend to prefer internal over external sources of capital, right? Internal sources, and they rather would issue new debt rather than to have new equity. And remember that managers make financing decisions, not the stockholders. So this survey is telling us what they value with certain consequences in terms of the financing that's getting used. And it looks, from the survey data, it looks like the managers, I got to take a break here. We're going to pause Camtasia briefly, so hold on. Okay, I had to go back to my man cave to get less interruptions in place, right? Where was I? Oh, yes. So managers seem to value flexibility and control. Okay. And see, what type of financing gives you the most flexibility and the least need to answer to anyone? Well, first off, internal financing versus external financing. You can consider that, right? With internal financing, you don't have to file with the SEC and you don't have to explain to investors what you plan to do with your money. In hindsight, you might have to come up with a good story to talk to your stockholders about in terms of, hey, you've retained earnings and here's what's going on. Now, would you rather issue new debt or new equity? Okay. Now, if you really are forced into access to external financing, and this is a little bit of a closer call, new debt might come up against you with certain covenants, and that restricts your operating flexibility. And you got to talk to ratings agencies and banks and so on. Of course, issuing new equity requires filings with the SEC and some possible loss of control. So very crucial. So these survey preferences are very interesting. Notice internal equity vastly preferred to the external. Straight debt is definitely preferred to the convertible debt. Right, debt over new common stock, then in place, and then finally you've got any financing over preferred stock, which is quite an interesting, not exactly a front runner when it comes to what people prefer, and certain consequences, of course, arise. Now, this data sheet is Damadoran's presentation of external and internal financing at firms. At U.S. companies, the internal financing is really the bulk of financing over much of history. Whenever there's raising of external funds from markets, firms are actually much more likely to use debt than equity. So you have internal financing as the large, sort of in this color screen, that sort of bright magenta or pinkish. Then the middle purple section is the external, right? And external debt, you see, is preferred over the issuance of common and preferred stock. Now, let's say, review this slide. Just take a gander at it and think for a second. Well, here's what's going on. I would expect the firm to be in much more financial trouble than the average firm. I mean, why else would it use convertible preferred stock when it could have used an alternative source of financing? And of course, the stock price response to the issue of securities seems to mirror this financing hierarchy. When new bond issues elicit, really positive stock price responses over new stock issues, you can see markets, reacting in terms of the priorities. All right, now what we've got to do, that's our end point of really that last section. What we've got to do now is deal with capital structure. When we talk about the trade-off between debt and equity in a kind of qualitative way, ultimately you've got to get down to details. So that's what this is about. We're going to look at certain approaches that we can be using, right, to estimate the exact amount of debt ratio that the firm ought to have. So let's go back to our big picture again. And right, this is that central optimal mix item now highlighted. Basically, we want to know, is there an optimal mix? And how would we find it for a given firm? So we've got several pragmatic questions that are really key here. All right. So you first off have the cost of capital approach, the enhanced cost of capital approach, the adjusted present value approach, the sector approach, and the life cycle approach. And what we're going to do is look at all 5 approaches, and they might actually yield slightly different results, and that's why we want to look at them. So the first one, the cost of capital approach. So this is actually the conventional valuation model for a firm. And of course, this is the centerpiece of the front part of our course. So the idea is really easy, especially if the cash flows are the same. And what we know is, hey, if we take the discount rate and you see it lowered, the present value has to go up, right? The key there is the cash flows remain the same. If that's not true, right, minimizing cost of capital actually might not maximize firm value. Other moving parts, right, to this. And this really recaps our discussion of cost of capital, right? The cost of equity reflects non-diversifiable risk in a business, and the cost of debt is the rate at which the business can borrow today. Remember that, today, right now, not historically, in its documents, from its past loans and so on. All right, in this sense, what it would cost you to finance your entire firm from scratch is what we're trying to get at right now. So the cost of capital, right, is weighted average cost from the different sources of financing. And remember, there's really only 2 components in the computation, the debt and the equity. Now, there are hybrids that you got to watch out for. So, for instance, convertible debt. The best thing to do there is to break the convertible debt into its debt and the debt, right, and the equity components. Break it into those components. Keep the bond portion treated as a debt and the conversion option as an equity. Okay. The preferred stock actually is a little messier because it's not really debt, right? Preferred dividends are not tax deductible. And it's really not equity either because the preferred dividends are fixed. So there's 2 ways to deal with that. You can treat it as a third item in terms of your cost of capital computation. It has its own cost potentially. The simplest measure of that cost is the preferred dividend yield, right? You could treat it as debt and then gross up the amount to reflect the absence of the tax advantages on preferred dividends. So $100 million in preferred stock with a marginal tax rate of 40% grosses up. Okay. So look at this. Best answer I can think of in that first situation. All right. The answer is no. Okay. Dividends yields are only a portion of what you have to deliver to the equity investors to keep them satisfied. I mean, of course, the Asian manager could respond, well, what if they're not satisfied? What can they do to me, right? The more power the stockholders have over the managers, the more likely it is that they're going to, look at the cost of equity view and say, well, it includes a dividend yield and a price appreciation factor, right? So remember, equity can never be cheaper than debt for any firm in any stage of its life cycle. Okay, equity investors always stand behind the debt holders in line when it comes to claims on the cash flows and on assets if there's a liquidation. There is, of course, an exception. We all know this. If you have a company with a negative or very low beta, its cost of equity might be so low that it's lower than the default risk-adjusted cost of debt. But such a company should actually never borrow money in the first place because it's, in such dire situation. So, it makes it a moot case Now, what we're going to do is apply the textbook example. Okay, it's a very simple example. The costs of debt and equity are given. The firm has cash flows. You see before debt and after taxes and reinvestments, $200 million, and a very stable growth rate of 3% per year. Right. So note that both, the debt and equity increases, the debt ratio goes up, but the cost of capital becomes lower, at least initially, as you take on more and more debt. See, that's because you're substituting in cheaper debt for more expensive equity. When you hit the 40% ratio, the cost of capital minimizes. Okay, that's the optimal debt ratio. Then after that, you can get your firm value. Use the same cash flow, that's $200 million, and the same growth rate, and you can change things to cost of capital with that, manipulating that equation there on the bottom. Really, what you've got here is the previous page in a new version, right? So it really doesn't add much. In every textbook, you're going to see this, though. It's the famous U-shaped cost of capital curve. If you have this graph available in a particular setting, you'll find, of course, the optimal capital structure is obvious. Okay, in most firms, all we know at the time we begin our analysis is one point on the graph, though, right? So that's the current cost of capital. So the challenge is to flesh out the rest of this graph. Okay. So let's look at Disney for our case study. There's one point we do know for Disney. Okay. So remember, we were calculating their beta on their stock in November 2013, say 1.0013. T-bond rate at the time, 2.75%, and so on. Right, we've seen this before, and you've got the cost of capital calculation down, one would hope. So this is just a reproduction showing us the current cost of capital computation for Disney. It uses the market value weights of the debt and equity, the cost of equity based upon a bottom-up beta, and the cost of debt based on their bond rating. Right, the market value of debt is estimated by estimating the present value of the total interest payments and the face value of the current costs of debt. So we want to frame our capital structure question as follows. Is there a mix of debt and equity at Disney's cost of capital that could be lower than the 7.81%? Okay. So the inputs for computing the cost of capital are the cost of equity and the cost of debt. The basic approach that we're going to use estimates each of these. Okay. And what we're going to do is look at different levels of debt, and different levels of debt impact the cost of equity, and the different levels of debt impact the cost of debt. And what we'll have to do is, look at cost of capital at all these varying levels of debt, look at the firm value and the stock price that results from each of those particular cases. So the groundwork for this starts off with, and of course, the unlevered beta for our firm. And we're changing the debt ratio, right? So you've got to estimate the beta for each of Disney's businesses. And then you can use that unlevered beta to get to the beta at every possible debt ratio that exists. Okay. So you can review that slide. Now, we go to the current financials, and this is a key step. This is one I'll just spend a little extra time on. So think about this. You're determining your firm's capacity to borrow in the long term. Okay. See, this is a stage where you're trying to modify the numbers to reflect long-term earning capacity. You want to reflect long-term earning capacity, not just the various issues that might arise in a single year of operations. Now, with commodity companies, you could potentially choose an average income level across their commodity price cycle. That's possible, of course, but you can take previous years and kind of push into the future some, again, sort of scenario analysis here, use averages and particular growth rates over time. Now, in this case, these numbers reflect efforts at bringing leases into the financial expense column because we want to treat the lease commitments as debt, right? So remember that that's part of the deal. And from the use of the unlevered beta that we can then lever in various ways, right? See different debt to capital ratios, and you use a formula that basically goes back to the risk and return section to get us an unlevered beta from our bottom up levered beta. So remember, the beta that got levered comes from the unlevered beta times 1 plus 1 minus the tax rate times the debt to equity ratio. Now, what we're doing, right, is calculating a levered beta in the table. So you're assuming all the market risk is borne by the equity investors. Now, that potentially is unrealistic at the higher levels of debt. So you got to keep, just be aware of that for certain, be cautious, I guess, way to put it. So you want to consider certain alternative estimates of the levered betas that apportion some of the market risk to the debt. So you might, when you're doing that, as Damodaran shows in the text, is utilize the unlevered beta calculation to turn it into a levered beta, sort of normal, but then also have the beta on your debt get calculated. The beta of debt is the rating of the bond estimated by regressing the past returns on the bond in every one of the rating classes. You're doing that against returns on the market index, right? So the levered betas estimated during that approach are actually tending to be lower than those were estimated in the conventional model. So this is just a little bit more complete way to approach it by saying, okay, at the high debt levels, we better be more attentive to the risks of carrying such debt. And so you see the cost of equity changing as the debt to capital ratio rises. Cost of equity is rising, right? So how do I estimate cost of debt? Okay, it's basically a manual computation. So you have circularity in the argument, so you got to watch out for that. The interest expense is what you need to compute your rating, and the rating is what you need to compute the cost of debt. So you can get around that circularity. You do it this way. Start with the 10% debt ratio calculation and assume that the cost of debt is the same as it was at 0%. Here it was 4.75%. And then you have a starting firm value, which is the market value of equity and debt. Let's say that remains the firm value when you shift up to that 10% debt ratio. So you're kind of holding the edge case constant, okay? Now, neither assumption is not too bad, although it might not really be realistic in certain cases. So you can revisit the numbers and do sort of a series of iterations of analysis, okay? You also want to assume that whatever is borrowed is going to be used to buy back equity, and that the operating assets of the firm are going to remain unchanged, right? Because all we're doing is adjusting the debt-to-equity ratio. That way you can basically isolate the effects of a recapitalization, okay? Remember the ratings table, going back to that. You look at the interest coverage ratio ratings for the classes of large manufacturing firms, for instance, market cap above $5 billion. And we have here our default spreads at the time of the analysis that Damodaran's doing. And you look at, this is a default spread above the long-term 10-year Treasury bond, all right? So you're obtaining the default spreads a couple of different ways. One way would be to get a sample of the liquid bonds within each ratings class and average out their yields to maturity. You find some source that provides default spreads by their ratings class. A good example is bondsonline.com. Okay, it used to be for free. Now it requires a fee, so it's a little harder to use them, or harder to justify using them unless you're really professional and need such access. Now, the interest coverage ratio usually has to be higher for smaller firms, so you can get generally similar ratings. And at Damodaran's webpage, you can find this in his ratings Excel spreadsheet. Watch out for special cases. There might be no interest expenses, so your interest coverage ratio will be infinite, a AAA rating, right? I mean, if you have no debt, this won't matter. If you have negative operating income, your interest coverage ratio is going to be negative, so you get a D rating. Some analysts like to modify that by using the average operating income over the last few years, get a sense of it, to sort of say if there was some interest being paid, what kind of rating would prevail. So you should try this doing it the 30% level. So you start by assuming AAA rating, and you're going to wind up with a different rating down the road. You're potentially going to have a AA rating down the road, because you got to pay attention to an iteration as you get a different debt to equity ratio, right? You got to adjust the debt should the rating change, right? Or the cost of debt, right? Remember, it's partly related to the default spread. So you do maybe the AAA rate and then redo the analysis under the AA rate and stop if you end up with the same rating. So the idea is, starting with AAA, you go through the table, and if you switch to AA rating, you better do another iteration. If you start in iteration 2 at AA, and you wind up with a different rating again, you should do a third iteration. So you're doing this until the rating stays constant. Okay, so try this particular example. Okay, and what I'm going to do is stop there for now, and I'm going to put this one up for everybody's consumption. All right, God bless everybody.